Hello and welcome to Simplicity in Stocks. Despite a recent small correction in the stock market, the Nifty is close to its all-time high. At such high market levels, finding value in large cap stocks can be challenging. In this video, we present 3 stocks that are undervalued. These stocks have been selected using data from Equitymaster stock screener. For the undervalued criteria, we have applied the following 3 filters: price to earnings ratio below 10, price to book ratio under 1, and a consistent history of profitability and dividend payouts. It's important to keep in mind that valuation is a subjective concept. What one investor believes to be undervalued may not be the same for another. This means that while valuation analysis offers insights, it's not a perfect science. It functions best when used as a guiding framework in conjunction with knowledge of its limitations and complementary techniques. Please note that this video is for information purposes only. It is not a stock recommendation and should not be treated as such. There is no opinion or view on any stock covered herein. ONGC. ONGC is a Maharatna company, India's largest crude oil and natural gas producer. It contributes about 71% to India's domestic production. Crude oil is the raw material used by downstream companies like IOC, BPCL, HPCL and MRPL, the last two being subsidiaries of ONGC, to produce petroleum products like petrol, diesel, kerosene, naphtha, cooking gas, LPG. The stock currently trades at a price to earnings ratio P of 7 times and a price to book PB of 0.8 times. The company has a consistent track record of dividend payments with a dividend yield of over 5%. On the financial front, the company reported revenues of Rs 1,579.1 billion for the second quarter of FY26 against 1,593.3 billion year on year. ONGC reported a net profit of 122.75 billion rupees in the second quarter against 98.5 billion rupees year on year. The management is expecting oil production to reach 20 million metric tons in FY26 and natural gas production to be slightly below the 21.5 BCM that was earlier projected. The company has faced issues with declining and mature oil fields. However, with the redevelopment of the MH field, the scheme for revival of the KG98/2 and the combined Western Offshore Development Plan, ONGC is trying to counterbalance the declines from mature fields. The monetization of new hydrocarbon discoveries with a sharp focus on deep water and ultra deep water exploration is expanding ONGC's resource base. These efforts, along with enterprise-wide cost optimization and digital integration, are expected to boost operational efficiency and improve the company's resilience in the quarters ahead. Bank of Baroda. Bank of Baroda is the second largest PSU bank in terms of market capitalization in India. It provides personal, business, corporate, international, treasury and rural banking services, including deposits, loans and insurance. The bank operates in 17 countries with 84 overseas branches. In 2019, it merged with Dena Bank and Vijaya Bank, boosting its network to over 9,500 branches, 13,400 ATMs, and services to 120 million customers. The stock currently trades at a PE of 7.9 times and a price to book value of 0.9 times. The bank has a consistent track record of dividend payments with a dividend yield of nearly 2.9%. In the second quarter of FY26, the bank's net interest income or NII improved to 131.2 billion rupees from 126.4 billion rupees year on year. The net profit, however, declined to 50.7 billion rupees from 54.6 billion rupees year on year. In Q2 of last year, the bank had a one-off recovery from written-off accounts which had elevated profits in that quarter. Without this one-off boost last year, the profit this year would have grown 22% year on year. The management has given guidance on advances growth of 11 to 13%, which will be led by growth in retail advances. following a trend of 18 to 20% seen in this segment over the last many quarters. In terms of net interest margins (NIM), the management is expecting 2.85 to 3%. Overall, Bank of Baroda is likely to see improvements driven by steady profit growth, improving asset quality, and strong capital adequacy. Power Finance Corporation. Power Finance Corporation, or PFC, is a leading Maharatna public sector NBFC under the Indian government's Ministry of Power. It specializes in financing power generation, transmission, distribution, and related infra projects. The stock currently trades at a PE of just 3.4 times and a price to book of 0.9 times. The company has a consistent track record of dividend payments with a dividend yield of 4.6%. On the financial front, PFC's interest earned rose to 288.9 billion rupees in the second quarter against 257.2 billion rupees year on year. The net profit in Q2 FY26 was rupees 783 billion versus rupees 72.1 billion year on year. Moving ahead, PFC will benefit from its strong positioning in India's growing power sector, particularly renewables. The company has a strong loan book driven by renewable financing growth. The asset quality of the company is also good. Investing in stocks that seem to be undervalued requires careful consideration. Such stocks may be undervalued or oversold, especially if the low price is due to temporary factors. However, caution is needed here, even if the stocks may offer value. It's important to do thorough research into the specific reasons for the undervaluation. Investors should evaluate the company's fundamentals, corporate governance, and valuations of the stock as key factors when conducting due diligence before making investment decisions. Happy investing!